turned into a horrible space.
Yeah. All right. Well, welcome everybody. Welcome to the news of the money world. I am Darcy Ungaro, and I'm joining the studio here with Rupert Carline, as you can see. And today we're talking about the role of emotions with investing, or the emotional investor. So a little bit of inspiration actually came from one of our audience who wrote into me. And by the way, if you want to ask any questions, there's a link in the show notes for those listening to the audio. It says "Ask Me Anything," and this one came via that platform. So this is from Leanne from Fungaray. Should I be changing my KiwiSaver provider if historically they perform well, but over the past 2 years they're not performing well compared to other providers? And so, Rupert, how are you, by the way, Rupert? You good?
Yeah, I'm good. It's been a long week and it's only Wednesday, but one more day and then my New Year starts, Matariki. I'm really looking
That's
forward to it.
right.
And
Yeah, well, I'm pretty
actually,
sure it's my first one. Pretty
but
cool.
it's also, well, slight digression, but I'm actually really excited about the celebration of Matariki as well, because I just think it's awesome. When I was a kid, a lot of the stuff wasn't really thought about. It wasn't a big thing, but it's part of Kiwi. It's part of culture of being a New Zealander, and I think it's awesome that we're starting to celebrate and making these things mainstream.
Yeah, no, that's cool. I agree. So what do you think about this question though from Leanne? Like, understandably, if you are actively reviewing your KiwiSaver and then you do an assessment around what this one provides versus that one, you look at the return and you can't ignore it. Like if another provider has a really good return from the previous period and you're tempted to move on over, then naturally that pattern of why you would have chosen that fund might persist. And when you see that it performs badly, you kind of keep on doing the same thing. But it kind of speaks to a larger issue. But I kind of wanted just to pick your brains, being heading up Kora KiwiSaver. You possibly see this as well. Do
Yeah,
you kind of have an explanation as to why one fund manager does better than another in any given season? Why aren't they all just the
no,
same?
definitely right. People employ different investment strategies, and I think one of the key things is that investment strategies work in certain market conditions and then don't work in other market conditions, and that's why one of the key things we talk to people about is saying returns should not be your primary driver of choosing your KiwiSaver fund. Realistically, it should all be about asset allocation, understanding where the assets are going to sit, and whether it's invested, followed by fees, and then performance is kind of the last little check that you can do. I think if you are going to choose someone based on performance, and I know that's what a lot of people do because it's really fundamentally we are investing for returns and we are investing to have a better retirement. What it's critical that you do is if you are choosing a provider that's delivered great returns, and particularly for a newish provider that's only been there kind of 3 to 5 years, it's really critical to understand why. Is it that they got a couple of calls right and therefore that's driven their returns? Or is it that they've got a fundamental investment strategy that you agree with and that you think kind of makes a huge amount of sense? And so that's why I kind of, for most people, that's really, really hard. And that's really, really kind of hard to see. But if you are going to base something on returns, what you're really looking for is you're looking for a manager that is consistently delivering returns. It's probably sitting in that kind of top quartile on a 1 year, 3 year, 5 year basis, ideally a 10-year basis as well. But I think what we do know is that it is very, very, very rare for a manager to continue to outperform over the long term. And so that's why it comes back to those other fundamentals around fees and asset allocation and thinking about where and how the money is being invested.
Okay, no, good point. Markets go up and down. Everything goes up and down. I'm looking at crypto right now. It's pretty crazy. Property,
Yeah.
shares, managed funds, individual ones. Everything's going up and down, right?
And that's what's so hard, right? Because controlling your emotions when everything goes up and down is extremely difficult. Controlling your emotions when you're sitting in a fund that hasn't performed very well for 6 months is really, really hard because fundamentally we are wired to make changes. We are wired to try and fix things when they go wrong or fix things when we perceive them to go wrong. Patience is not something that is inherent in many people's human DNA. And so that's what's really hard, right? And you've got to control your emotions to make sure that you're not making decisions, long-term decisions, using short-term data points.
Yeah, agreed. And I'm one of those rare people, it seems pretty rare, where I still genuinely believe there's differences between men and women. But what I do believe in terms of men who invest is that often emotions are actually quite significant. And it's different, right? Because we're wired a little bit differently. And when I see that something is wrong, my first impulse is to fix it. And my wife is constantly telling me off, saying, "Hey, just listen to what I'm saying. I don't want you to fix every problem," right? I'm sure if you probably heard something similar, right? But
Yeah.
why is it that you think we just have this natural impulse to fix something? And then what I'm, I guess, drawing on is an article that you have on the Coda website. I don't even know what it's called, but all your personal instincts could be problematic when it comes to wealth creation. So number one, the fix and improve mentality. That's kind of what we're talking about. Why do you think it is that we have that instinct?
Oh, look, it's just from humankind, right? Whether it be from day dot, it's been ingrained in our brain that, look, when stuff goes wrong, we have to do something about it. And sometimes you might call that lack of patience. Sometimes you might call that a number of other things. But it's just one of those things that we grow up with. I've got a sore leg. I need to do something about it. I've got a sore tummy. I need to do something about it. I'm hungry. I've got to do something about it. And I think it kind of comes back to, I guess, that Maslow's hierarchy of needs, where fundamentally it's all about security, safety. That's what we have ingrained in us, and our psychology means that whenever something is wrong or whenever we think something is wrong, we just have to fix it.
Yeah, that's right. Which is difficult though when you're investing, right? Because it's a long-term decision, which we know intellectually at least, and we've been told this, and we probably genuinely believe this, that there will be ups and downs in the market, but we fail to realize that it makes us feel up and down. And so when our feelings kind of rub up against that reality, the impulse is strong to
But
avoid the pain, right?
but it's because it's something that we don't see every day, and it's something. So if I sit there and say to you, "Oh, cool, I've got another traffic jam, and it's taking me 45 minutes to get into town," whereas on a Saturday morning it would take me 5 minutes, you're going to go, "That's pretty normal. That's kind of what it is, and there's not much I can do about it." But it is what it is. If I was to turn around to you and say, "Hey, look, stock markets have dropped 40%, or let's talk about what's happening right now. Stock markets have dropped 30%. You've just lost $30,000. That's going to kind of your retirement forecast has come out from your Kiwi provider. You're now going to have a whole lot less in retirement than you were expected to have last year." I mean, that is really, really scary. So for me, from my educated, easy to say point, when I go, "Well, don't worry about it, Rupert, because I know you haven't been through this before, or you might have been through this before 10 years ago, but the theory says that it's going to recover. The theory says this, this, this." That's a really hard message to take in, because it's a message that I'm only starting to listen to, and I've only needed to listen to and hear once every kind of 5 to 7 to 10 years. And that's what makes it so hard, because it's so abnormal, and it goes against every single one of our instincts, which is, I've lost, how do I fix it, and how do I make sure I don't lose anymore?
Yeah. Let's talk about this confidence thing as well, because I guess like I've kind of seen this a lot with those that move in the property space, the sense that because historically property just kind of always does what it does, and for quite a long period of time, it's like it's done it without hardly having a break. Understandably, there's a sense of confidence that property values always go up, and there's never any sort of volatility with that, which of course we know that's not true. Intellectually, we know that's not true, and right now we can definitely see that. But when your confidence is shaken, I'll just pull that article up again. How kind of critical is that? Because I guess we're confident, we almost take credit for what the market is doing on its own, right? And then when the market doesn't do it, our confidence gets shaken, doesn't it? And then we kind of overtrade as a result.
I mean, and I think, look, you mentioned the male female point, right? And I think here, I'm glad we wrote this in the article, slightly old article, but now's a great time to come back to it. Confidence is one of the main reasons why men often are worse traders than females, because women often will make more considered decisions. They'll think through there and make a research-driven decision rather than an emotional decision. Kind of on one hand, you think about the workplace where a lot of women might be disadvantaged because they don't have the confidence to quickly follow their gut and to be as aggressive as a lot of men are. But actually, that is what makes them often very, very good investors and, to be honest, very good employees as well, because they seem to think through. One of the worst things you can do as an investor is say, hold on a sec, I know the theory says this, I know the market says this, but actually I know best. And there's an interesting tidbit. So someone was talking to me the other day about some research that financial advisors often their own personal investment portfolios are significantly worse than their clients and what they do in the market, because they think they know better than the rest of the market. They think they're in that top 1%, and that confidence is very, very, very rarely well placed.
Have you seen my portfolio lately? Have you seen my portfolio, Rupert?
Oh, look, people like us, they're all highly concentrated. It's do what I say, don't do what I do.
That's right. 100% Bitcoin. Loving it. It's great.
Exactly. But I find it really interesting, right? Because you kind of go, it's when you start to breathe it down. And so it's this confidence point. It's this point around, I think I know best, which, I mean, Russell Investments have done some great work, and they've actually managed to quantify the cost of this confidence. And so Russell Investments believe that the average retail investor will underperform the market by 3 to 4% per year because they think they know best. And often when they think they are buying low and selling high, they're actually selling low and buying high. Because what we know is when the market moves so quickly, and it takes so much time to get your confidence up to be able to kind of go to get the confidence that actually this is a sustained rally or a sustained recovery, or on the other side, it takes a long time to get your head around the fact that, yeah, this is a market downturn. And so the fact that you think you can pick it often means that people just miss out and significantly underperform as well for a long time. And I know, look, I'm a big fan of passive investing for that very reason. But actually, even when you look at most managed funds, they will still keep the majority of their funds invested on the way through. And it's really just tilting the portfolio around the edges, unless you're with kind of a hedge fund, or even Kiwi Land, there's probably only a couple that are really willing to take real bets. And that's why you see significant volatility on their returns, because sometimes they win and sometimes they don't.
Yeah, and I guess that comes back to Leanne's question as well, right? Because it's not necessarily like if I was a fund manager and I really wanted to chase amazing returns, I'd probably struggle because I wouldn't be measured on that. I'd be measured on a benchmark, because most investors would like to see consistency. And so that would kind of stop most from taking a lot of risk, because they really want to have a consistent rate of return. Otherwise, their performance looks terrible and no one wants to be with them.
Well, exactly. And I think, though, and the problem is, though, that's why I kind of said you should be thinking about how do you pick, unless you can find you're one of those very rare investors and that can kind of be winning in the 1, 3, 5, and 10-year basis. It's pretty rare that you want to be in the number one provider, particularly the number one provider on a 1-year basis or a 3-year basis, because often they've taken some bets to get to that position, and often those bets will unwind. And I think what's scarier with a lot of those types of investors, particularly, and this is more hedge funds rather than KiwiSaver, they get a couple of bets wrong. Their performance falls, particularly relative to their peer group or relative to their market. And what do? They increase the risk, because it's basically double or nothing, triple or nothing. I got to win it all back.
Yeah. Well, yeah. And let's maybe talk about the loss, right? So right now we're looking at some pretty decent pullbacks in a few areas. And some would suggest that we've probably got a little bit more of that coming. Obviously, no one knows the future, so we kind of have to check that right away, just to say, hey, just because everybody's saying that doesn't necessarily make it true, right? But let's just say that we look at our KiwiSaver balances or our share portfolio, and we see a decrease. Talk to me about why often we convert that loss into a dollar when it's a loss, but when it's a gain, we convert it to a percentage. You know what I mean?
It's a great point, right?
Because I'm looking at point number 3 here, right? Losses always mean larger than gain.
And I think it's for some reason losses. I mean, I find losses really interesting, right? Losses mean a lot more to you as an individual, but also losses are something that most people are unwilling to talk about. So everyone talks about the gains, everyone talks about it, and I think this comes back to the psychology of money, and particularly the psychology of money in New Zealand, where we kind of feel it's a bit garish to talk about the amount of money we make. We feel it's kind of inappropriate to talk about. So me turning around to you and going, "Cool, I just made 50 grand yesterday or last year on my investments." Everyone's going to say, "Oh, look how much you've got." Whereas if I turn around and say, "I lost 50 grand," the reaction from everyone around me is also going to be really different. They're going to say, "Oh, that's pretty harsh. The market's pretty bad," and I might even get some sympathy. Whereas it's the approach, I think, not only of the person making the loss, but also the people that you're talking to about the losses, which is so different, because we are hardwired to think about these things so differently.
That's a good point. It's interesting, isn't it? There's so much psychology in money that you can't underestimate just how much mental stuff goes into the resource stuff, right? Like the psychology is like 99% of the financial performance.
And that's what a lot of research says, right? The psychology of money. And I know this is oversimplifying, but the psychology of money is where most of it sits, right? Like we've said all along, most of your returns as an investor come back to asset allocation and having the confidence and bravery to stick with that asset allocation and never make any changes. But fundamentally, if you are not willing or able, or you think that approach is going to cause you too much stress, then we need to make sure we avoid the worst of those losses to not put you in that situation. But that's not an investment decision. That's not a strategy decision. That is 100% a psychological decision.
Yeah, it's a continuous move in the same direction over time, the old investing game. But we just don't know when there's going to be bumps along the road. But we know that there will be. But when we see it, it shouldn't be too much of a surprise.
No.
And I'm genuinely fairly impressed with the people that I've been talking to lately, especially just at not how philosophical they are, but just how genuinely a lot of people that I'm talking to right now actually know that this is a long-term investment, and they're not being rattled. They actually know that the ups and downs come, and they're staying the course regardless, which is pretty cool.
Well, I think we're in a really interesting time, right? I think the last 15 years have been. I'm fascinated to see how history looks back at these 15 years, but in particular, because we've kind of basically been in a bull market since 2008. And then, but also with that short interruption of the COVID crash that happened in 2020. And I think, so what I do wonder is the COVID crash, markets dropped 35%. They managed to recover about 6 months later. I do wonder whether people just assume that is the normal cycle, and whether that is actually what's going to happen. It's just kind of, and you've got that Fed put, which is going to sit there and kind of come back to the rescue of markets. But I also think there's a combination of that with a number of investors. I also think there's just been a lot of noise over the last couple of years around investments. And so people are more educated than they all were, making sure they kind of talk about, actually, it's pretty common on social media now, or particularly, I guess, for me, because I follow mainly finance things. But you kind of seeing a lot of buy the dip, buy the dip, buy the dip. A lot of conversations around looking through the long term. And I just think there's a lot better conversation and communication around this topic than there probably ever has before. And I also think what happened in 2020 was a really good example for people, where there were a lot of people that switched funds during that process. A lot of people thought that the carnage was going to be a lot worse than it was. A lot of people got badly burnt by taking that approach. And so it was a really good education process for a lot of people.
Mm-hmm. Yeah. And I think like there's this one piece here that again, I'm just drawing from this really good article that you guys put out, point number 4, beware of your memory, mentioning this thing called availability bias, which kind of is connected to what you were just saying, really. And I think back over the last few years, I think about March 2020. I recall how deep things went down and then how viciously fast things rebounded as the Fed put kind of came alive, and then kind of watching over that 2-year period, just how whenever there was any volatility, the buy the dip strategy was absolutely the best thing to do. How much does that potentially set us up for a fall when we don't look at reality for what it is and we just remember what was, especially with what our recent history says?
And I think that's a really, really good shout, right? So this article that you're referencing, that was written in March 2020. And so here we're focusing a lot on the downside. I think clearly we need to update this, because what I see with a lot of people that we speak to, with a lot of the investment, the chat forums, etc., is I think that the recent memory is making people believe that the current downturn and the current market move is potentially going to be short term. And so we see lots of people that are looking to buy a home in the next 1 to 2 years that are still invested heavily in the share market, that people are taking an inordinate amount of risk when they probably shouldn't be. People have forgotten that actually, on average, a downturn can last 3 to 4 years. On average, the markets can fall 35%. They can take 18 months to get there, and then they can be kind of 4 years from peak to recovery. But my kind of read of social media that I look at, my read of a lot of the kind of market stuff at the moment is, don't worry about it. We saw it in COVID. We're going to see it again. We'll be fine by Christmas. And I think that's a really dangerous trait to have if you are kind of expecting another COVID style recovery.
Yeah, agreed. Okay, well, what I'd like to just flip on over now is, so we've talked kind of about some of the dangers, and obviously these are some short episodes, so it's not like we're going to be able to cover all of the dangerous elements here and the emotions with investing, but I want to touch on some of the things that we can do as everyday investors to keep ourselves safe from ourselves, because we don't want to be we don't want to be unemotional, purely logical beings. I'm a big believer, hey, we should bring all of ourselves to all of our investing, because if we completely ignore our emotions, that's possibly dangerous as well. It's just whatever leads it. So I want to just have a quick look at this article from Vanguard here. Let me just pull it up. So it just talks about some really cool tips. And the first one I really love is this whole flip the script idea, because there's a lot of ways that you can reframe it. Here, they're talking about it in a completely different context. But what I like about the concept of flipping the script is that you can kind of reframe what you're going through to be something positive. Like for me, for example, I'm currently trying to build up my core investments, my well-diversified core allocation with what I'm investing in. I'm trying to build that up. So I'm looking at this downturn, hopefully coming up in the market. I'm genuinely really excited, because I'm not looking at the dollar value of what I already have. I'm looking at the dollar value that I have to part with to get a little bit more. And that's now genuinely on sale. So in my mind, I'm running a script that this is a fantastic time to invest. I'm not just saying it, I genuinely believe it. What do you like? Do you have any other examples of flipping the script in your world?
Yeah, I mean, I think 100%, right? I think you've got to go. So the way I look at a market like at the moment is exactly what you've just said, right? So my read and how I think about it is going, okay, we're 24, 25% down year to date in the US. US market's the only one that really matters. We know that it's potentially got 35, 40%. That's pretty scary. Maybe I should do something about that. Or the alternative way I can look at it is go, but I also know peak to trough on average 3 to 4 years. So no matter how bad it gets from here, I think, yeah, look, and this is not financial advice, by the way, but I think in 3 to 4 years, it's pretty hard to see me losing from this position. So there might be some pretty scary times, and but I'm kind of a 10-year investor, so I don't really care. That to me is my way of flipping the script. I'm using the historical data of a lot to kind of reframe that conversation to go, I'm no longer scared of another 10, 15% fall, because I'm actually focusing on 3 to 4 years, and I've got good rational thinking around why I think I'm pretty safe on a 3-4 year basis.
Yeah, that's cool. Let's keep going on this one. So I like this next one, enact a waiting period. So this is in the context of, hey, if you recognize the fact that maybe your emotions are starting to take a little bit more of a driver's seat with your decisions, then enact a waiting period. And I think with KiwiSaver as well, it's quite handy, right? Because it's a little bit difficult to change out. Because the worst thing that you could potentially do, I shouldn't say the worst thing that you could potentially do. There's a lot of bad things that you could do, but one of the dangerous things that you might be tempted to do is when things are really scary around you, to make a decision in the height of fear, because you could be moving from a growth fund into a conservative fund and therefore lock in the losses. That was the best example of March 2020. Enacting a waiting period, I think, is really good. Now, this could be a personal rule. It could be, maybe it's a rule with the platform that you're investing through where there is a delay. Or maybe it's just thinking about user experience. We all look at user experience with our apps, with our banks, whatever it is. We look at that as, hey, the easier it is to interact with them, the more likely you're going to get in and out. That's actually the problem. So having some sort of waiting period or friction can be a really helpful structural piece that you put around you to stop you from making dumb emotional decisions. Does that make sense?
Yeah, it does make a lot of sense. I think it's hard to do in practice, though. And I mean, I just thinking about me personally here, right? Where I'll be thinking about things for days and days and months on end, often, or days and days, weeks before I make a decision. I think I saw some of those other things down below, and I think the accountability and conversations is where I see the most powerful piece, right? Because for my perspective, I go, actually, what I have come to realize on everything is that I only have one view. And sure, I'm pretty strong in my views, but there is no way in hell I am smart enough to be the only one with a view. And so what I found is the best way to control your emotions and control your way through is actually to find a couple of people that you can talk this through with. Sit there and go, hey, look, I want to do this, and this is what I'm thinking about. Here are the 3 reasons why. What do you think? And if you've got some people around you to hold you accountable, and you are willing to listen to those people and engage in a real conversation, to me, that is the best way in the world that you're going to be able to control your emotions. Though I also understand that it's really, really hard for people to find to have those conversations with. And I think as much as people disparage and potentially don't want to pay for financial advice, that is what a financial advisor does for you. They're willing to challenge you. They're going to let you make your own decisions, but challenge you and have some conversations, and hopefully ensure that your performance isn't 3 to 4% worse than the market, because they've talked sense into you on the way through and made you really think about controlling your emotions.
Yeah. And then I guess that's pretty close to home for me, right? Because it's kind of what I do.
No, but it is, right? And so, I mean, you and I, we spend a huge amount of time talking about different things, and whether it be crypto, whether it be stocks, whether it be what. But actually, I think to me that's an extremely valuable process, because if I'm about to do something, I go, well, what did I talk to Darcy about? What did I talk to kind of Warren about? What did I talk to all of these people about? And they're going to go and bringing all of those perspectives into any decision. And I think that's probably the most powerful thing. It's going, how do you make sure you get advice and you get help? And it doesn't need to be formal advice. It can just be a couple of mates that you're going, hey, I'm about to do this. What do you think?
Yeah, that's right. And ideally some diversified advice as well. Like qualified advice is great.
I know I talk to you about whenever I'm thinking about the crypto stuff, and you just say go long, 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 long. And I talk to Warren, and he says go short, 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 short. And I just have to figure out my way in the middle.
Well, that's why that is the middle definition right there, right? You're just average. That's good.
Exactly.
No, that's cool because and just going on from that article, right? I love this one. So this is a quote again, drawing on that Vanguard article. As an advisor, I respect how important my clients' emotions are. In fact, Vanguard research has shown that about 40% of the value an advisor provides their clients is emotional, which is crazy, right? Like I know that because I often ask people when I'm dealing with them, what aspect of what we just talked about was the most valuable? What did you get the most value out of? Because I'm just trying to refine my process and make sure that I focus on that part and not all the other stuff that no one really actually finds valuable. And I can confirm like that is totally true. Now, would they specifically seek out emotional support? No. But that effectively is kind of what financial advice is, right?
Look, I sit in the Hobson Wealth offices, right? It's a big financial advice firm here in New Zealand, and kind of sitting in on a few client meetings and sitting in with them. 100% of what they do is they are giving comfort, and it's the psychological element that kind of adds the value, right? The investment stuff, look, it's fine. It's not rocket science. It's not groundbreaking what they're doing, but actually the best advisors in the world are the ones that are great at listening, showing empathy, and providing comfort to their clients.
That's good. That's good. All right. Well, unfortunately, we're talking remotely, so we can't cuddle each other and actually show genuine caring empathy, right? But just to demonstrate how it works, it's good.
Well,
it's really good.
One day, and we can't even blame COVID. We can't even blame. Even if we saw each other, we'd be allowed to have a cuddle now.
That's right. I know.
Through our masks.
Awesome. I'm just thinking about the cold weather, of course, not my genuine emotions. But no, that's a really, really good chat, really timely chat. And I think for those that are listening, I know it sounds trite, but we are investing for the long term. So all the decisions that you made to set up your portfolio exactly as it is right now you got to just hang on, right? Like that's kind of like the best advice is not to make sudden rash decisions. You just kind of hang on tight and stay the course, right?
Don't use short-term data to drive long-term decisions. You've set yourself up. You've made decisions. You've made reasoned, thought-through decisions, and there is nothing in the current short-term market movements which should force you to change those decisions. As long as you set yourself up properly, and I think that's look. There's no question, right? At the moment, it's pretty scary. We're hearing a lot of negative news, but what we do know is that trying to pick it, trying to understand exactly what's going to happen, it's really, really, really hard. And if you are better and you kind of can pick it, and then fundamentally you should be a hedge fund manager.
There you go. That's right. All right. Well, great chat. Great chat. Again, if anybody wants to ask any questions that might inspire next week's episode, please just visit the show notes, click on Ask Me Anything, and fire away. Rupert Carline, thanks very much for having this discussion with me. Appreciate it.
Thank you.
Awesome.